We're joined by Uwe Parpart. He is a chief strategist at Reorient Financial Markets right here in Hong Kong. Uwe, thanks for coming in.
Yeah,
Let's talk about what we saw yesterday in the Bundestag, because it is this Finance Stability Fund that they were voting on, expanding that, and Angela Merkel got a huge majority, much more than most pundits were thinking.
Well, that's true, but the actual majority she got came from the opposition parties. In her own party, there were significant numbers of votes against it, and in her coalition partner as well. So she has a problem with this policy. There's no question about it.
Is it enough, though? I mean, they expanded, but they're not. Can Greece survive this, or is there? We are moving relentlessly towards some sort of haircut, or whatever you're going to call it, a default?
Short answer is no, Rishaad. This is not a liquidity issue. This is a solvency issue.
Of course it is, yeah.
And, by having these bailout funds, you're injecting liquidity, but you're not actually addressing the solvency issue. And that's what has to be done. The debt has to actually be reduced. The economies have to be brought up to speed again, and most importantly, we have a situation in which I think a country like Greece might be better off without the euro.
Yeah, well, we can discuss that. I don't think there's many people really predict it's going to fall out of the euro. There's no mechanism for that happening. A little cling on there, and the political project would be in danger if Greece was to drop out. But I want to also just talk about the US a bit.
Yeah.
Well, a little bit of better news on the economy come through, but one swallow does not make a spring.
No, and Bernanke is right. The unemployment situation in the U.S. is a national crisis, and it needs to be addressed. But again, I don't think it has to be addressed or can be addressed through liquidity by QE3 or something of that nature. It has to be addressed by much more fundamental change in the U.S. economy. The U.S. has gone out of manufacturing in the world. It's lagging behind countries like Germany in exports. This is horrible, and this has to be changed.
Uwe, well, that of course brings us on to Asia, but I guess your baseline scenario here is of one which I can sense is very gloomy for the US and the euro area.
Yeah.
What happens with them?
Well, what happens is that they will probably go through another recession. It's almost inevitable at this point. I don't see much that can change that. And for Asia, that's not a good thing, but it's also a great opportunity because by comparison, Asia to investors will look better than Europe or the United States. And, I think especially China will benefit, but possibly even Japan.
Very quickly, Uwe, well, I'm going to talk a bit more about it, but you can't just say Asia as a whole, China you say, but some of these countries are export-driven, and places like, let's say, Hong Kong could suffer, couldn't they?
Yeah, absolutely. The problem with Hong Kong is inflation. We're importing a lot of the inflation from China, and China has to get that under control. That's urgent. And there's a simple method of doing that in terms of letting the currency appreciate faster. That's a political issue in China that prior to the change of leadership is unlikely to be resolved.
Yes. We were talking about that China could actually control its inflation if it increased, of course, allowed its currency to appreciate. Now, here in Hong Kong, though, we do get a lot more talk about the peg with the US dollar being under pressure, and that perhaps it should be, the whole currency arrangement should be changed. Well, we've been hearing from people today who suggest that this sort of argument only makes itself heard when we have volatility on the markets.
That's basically right. I mean, people can't seriously suggest to remove the peg or even to change it, because it's one of these things, if you change it once, people will continue to expect that you'll change it again, and the whole purpose of the peg is gone. So the problem for Hong Kong is it does not have an independent monetary policy, so it imports inflation from China, but it has to stick with the U.S. zero interest policy, and that's a nasty situation. So we'll have to live through that. I think it's possible, but it's it's trying times.
Uwe, what about the Hang Seng? It's the worst performer in Asia in the third quarter. Do you have any reason for that, do you think?
Well, it gets the worst of two possible worlds here, right? I mean, on the one hand, it reflects, of course, what's going on in the West, what's going on in the United States, and the dollar peg, makes that sort of very obvious and direct. And on the other hand, there are issues in China, especially inflation, which Hong Kong also has to suffer from. So when you're at the intersection of those two bads, then it's bad.
Yeah, well, two negatives don't necessarily make a positive, do they? But let's just look at the prospects looking into the fourth quarter. I mean, beaten up investors in most parts of the world now. Do we get a recovery?
We will get liquidity infusions, whether it's through the ECB or whether...
I'm talking about equity markets, actually.
Yeah, I mean that.
Yeah.
I meant that. Yeah. And, you know, we get these liquidity infusions. As a result of that, equity markets go up. That's what Bernanke counted on with QE2. He got that. He got equity markets going up. Some U.S. companies...
You also got inflation going up in this part of the world.
That's true, but in the U.S., you know, there's so much deleveraging still to go on. So inflation, yes, but I think, again, equities are your best hedge against inflation in that sense, right? I mean, at least you got something there that you can count on that will go up with the tide. And I think this is, for professional investors, picking carefully equities in Asia right now. They are as cheap as they have been in decades. But you've got to be a professional to do that. It's not going to be the kind of game...
But you play the long game, don't you? You're not going to be in today and out tomorrow, are you?
Yeah, no. I mean, that's exactly right. And, you know, you want to pick, in particular, equities which are, you know, have a good cash flow, which are somewhat defensive. You find a lot of those in Japan with the utilities. You find a lot of that also in China. And you can find a lot of that in Hong Kong.
Okay, and, well, you know, looking at the gold price as well, I just want to touch on that. I'm going to talk much more on all this. You know, has that surprised you?
The sudden drop has been a bit of a surprise, I think, but it was bid up so badly. I mean, it was just amazing. But if you look at what happened to the copper price, for example, it was just horrible, right? I mean, a total crash there. And I think what you're having is people kept on bidding this thing up. There comes a point where some big hedge funds just dump a lot of that, and that's what happened here.
With us in the studio we have Frances Cheung, Senior Asia Strategist at Credit Agricole CIB right here in Hong Kong, and Uwe Parpart, Chief Strategist at Reorient Financial Markets, and of course we've got Zeb, and we can't forget Zeb, can we, John? Like...
Can't never forget Zeb. Why should we forget Zeb?
They like to sometimes.
Zeb is a legend amongst journalists in the financial world.
I think you should start off asking the questions.
Oh, okay. Uwe, just apart from your financial experience, 7 years in the German Navy in a submarine, I would imagine for the next 7 years in this market, you also want to go underground.
Maybe not for 7 years, but for a while for sure, yes. I mean, this is clearly a trying period, and if you have cash, hold on to it. I think at the moment, for professional investors, maybe equities.
How about gold or commodities?
I would stay away from that. Gold is a bet against the end of the world. When the end of the world comes, what do you do with gold? You can't eat it. I'd rather have a handful of rice.
Is this something you actually echo here, Frances?
Actually, I think I do agree, like, for example, equities. Actually, for some Asian equities market, they are still quite undervalued instead. But the thing is, in the very near term, all Asian assets, as a type of risk assets, of course, will suffer from this risk aversion. For example, similarly, I'm quite bullish about sovereign bonds in Asia in the long term. But then recently, we have been seeing some sell-off at long-term bonds, especially for Thailand, Korea, etc.
It's been interesting. We've seen throughout this market route investors, as they take this risk off the table, the emerging markets have been hit particularly hard. See the sell-off we've seen in Jakarta and Thailand.
Are those gold as well, Zeb, you know, at the same time?
Everything. I mean, it's been a terrible copper. We were just talking about this a short time ago. Frances, where do you see the most upside then across the Asia?
Actually, I would say there is not too much decoupling between Asia and the developed world. If you compare to the last credit crisis, for example, Asians' dependence on exports has not really much improved. So we depend still to the same extent on exports, external demand, etc. And it is very ironic, but if you look at what happens during the U.S. downgrade, after that, actually we would have expected some asset reallocation from treasuries to other sovereign bonds, but what happens is just the opposite. We have U.S. treasuries continue to rally. So it seems that we are still pretty much kind of a risk trade here.
Francis, Germany is more or less saving the euro right now, but again, some are calling it Band-Aid. There's someone discussing we should be seeing $1 trillion in rescue, not $1 billion. Fundamentally, as you've been doing in your research, Spain, you say Italy is more or less bankrupt.
Solvency issue, not a...
It's a solvency issue. It's not a liquidity issue. And therefore, by throwing a lot of money at it, you're actually, in the short term, helping equities, for example, but you're not helping the fundamental problem.
So if it does go, they go bankrupt, it's quite a big thing for Spain and Italy.
Right.
The impact on Asia, how do you assess that? I mean, is it about banks' exposure or
it's not that
lending,
big a deal.
freezing
An
up?
orderly bankruptcy is a fine thing for the economy. Okay, Henry Ford went bankrupt I don't know how many times before he actually got his company going. You need to
different to a country, though.
Yeah, it is right.
you need to put but never mind. You need to at some point
Okay, but
put
Lehman,
things out of their misery.
Lehman went bankrupt, and we saw the shockwaves of that. That was huge.
But Italy or Spain going bankrupt, it's a whole different ballgame.
Well, I mean, bankrupt. It's not as though they're shutting down at that point. What it means is, you know, somebody has to take a haircut. The debt has to be reduced. You cannot keep. Look, it's such a simple equation. You look at a growth rate that is way, way below, in fact, negative, when the interest rate is, 10%. There is no way of closing that gap without cutting the debt and without getting the economies going again.
Francis, the impact on Asia from that?
Well, actually, what is your baseline scenario, first of all, before we discuss the impact?
Our base scenario actually is not for example, for the U.S. To go into another recession. We are quite cautiously optimistic about the European debt crisis. Things will at last find a resolution, whatever that is. So overall, I would say Asia will continue to be quite resilient. Of course, as I said, we still depend on exports, but we have quite strong domestic demands. We have other buffers, such as monetary policy. We have been tightening a lot previously, so which can be very easily reversed. And then the fiscal position here in Asia, debt to GDP ratio, etc., is much more comfortable than in the US and Europe. So there's a lot that the government here in Asia can do to try to steer the growth to the right path.
Well, the Germans giving us some reason for optimism this Friday with the Bundestag approving, expanding the stability fund. What's your take on this? Do you think that they did this to grit it teeth, or it doesn't matter? What do you think?
The interesting thing is that the people in the Bundestag who are best informed about the situation voted against it. All right.
So that means the majority is uninformed?
It's very interesting to realize that the left, the opposition, voted for it without exception, the Greens and the Social Democrats. On the other hand, in Angela Merkel's own party, there were 11 people who voted against it, and the coalition partner, 4 against it. They're the ones who've been actually addressing the issue. The rest are basically saying if the euro goes, so goes Europe. I think that's nonsense. The euro has to change. It's not that the euro will go away, it's just that the euro will have to in some way become a different kind of currency.
Uwe, how much do you think the German people want the Deutschmark back?
They want it very much back. I just spent the summer there, so
Recent poll actually said 44%.
Yeah, but if you ask the majority right now, there's no question that they want the German mark back, and there are good reasons for it. Yeah. People are scared.
Francis, I want to get back to what's happened with equity markets in Asia. I want to just talk a bit what Seb's been talking about this week, which is the Hang Seng being the worst performer. Uwe and I touched on it earlier, but why do you think Hong Kong got sold off so badly in the third quarter?
I think we are kind of suffering from a double whammy. First, of course, we have the slowing down US, but then there was lots of takers there kind of more or less China-related. So there are also worries about the Chinese growth, about local government debt here. So overall, we seem to be suffering exceptionally more.
Yeah, I mean, it does also seem at the moment that, through the last few weeks, that the noise, the bad news out of China, there's a noise, isn't there? There's
debt noise.
Exactly. You can feel that things are not as rosy as they were. Do you agree?
Actually, it really depends on the estimates. According to most aggressive estimates, even taking into account of the local government debt to GDP ratio in China is only 40%, which is well below, the international average. But the thing is, there are increasingly many local news talking about very high interest rates.
I've just got to tell you, we've got a bit of breaking news that's coming through, which is that the Hang Seng, as we're talking quite serendipitously, that it's at the lowest of the day so far, and if it closed at this level, it would be the lowest close in a decade. Now that's something else, isn't it?
But the banks have been pummeled. Sorry, Zeb.
No, it's just remarkable to see these levels. It's 17,610 right now, down 400 points in the session. Where do we go? Do we go down to 16,000?
ICBC, Bank of China, all these companies are really...
Because of the debt issue that we're talking about, yeah.
Oh, absolutely. I mean, HSBC, after all, is a British bank, and it's got huge exposure all over the place, and so does everybody else.
Do you think, Uwe, that the Chinese debt situation could be as big a concern as maybe US or Europe?
Not for a while. I agree with Frances that this is not going to happen anytime soon. There are real issues in China, but I think they're different. They're not the issues of debt, the issues of restructuring, the issues of productivity, and so on and so forth. China's got a good ways to go at 8 to 10% growth.
Can I argue there, Frances? Is it time maybe to buy financials, having been sold off so much?
It really depends on which background it is, right? If it is Chinese bank or if it's like Hong Kong or more Asian background, that I would be more favorable to buy these. But if it is like in the Western world, right? So maybe we have to still wait for a while to let all the dust really clear for the road ahead. But I think going back to the Chinese debt problem, I wouldn't say it is a problem because if you look at all the debt issue in China, actually the government there do not really rely on all these debt proceeds for their fiscal spending. You will notice very interestingly, on the one hand they auction debt, on the other hand they auction the so-called MOF deposits.
Yes.
So they have a lot of cash left, and then in between they actually earn the interest differentials by auctioning back the deposits to banks. So you can see actually the government is settled a lot with cash.
They have a bigger problem with their foreign reserves than with their debt.
No, but thanks a lot, guys.
They shouldn't buy bonds. They should buy Europe. So.
Uwe, thanks, and Frances, thanks as well.